The autumn statement is here, and I want you to share your experiences in the comment section as to whether you believe the Labour government delivered on their promises, or if you believe they did not. And finally, if you believe this budget was a balanced one, please share your experiences. In this video, I'll be highlighting to you what this budget means to your income, and I'll provide you with various tax-efficient ways you can use to reduce your taxes and keep most of your hard-earned money in your pocket, even with these increases that I will be exploring in this video. If this is your first time here, my name is Amma, a qualified accountant and a tax professional with over 10 years of experience from AB & Co Accounting and Tax Services Limited. The first thing I'll be talking about in this video is about capital gains tax. This was highlighted in the autumn budget. What is it about capital gains tax? So the rate of tax on the sale of residential properties remains unchanged, which is 18% for net gain that falls within the basic rate band. And for net gains outside the basic rate band, the rate of capital gains tax is 24%. That remains unchanged. What has changed from the 30th of October 2024? If you sell any other assets, excluding residential properties and carried interest, your rate of tax on your net gain is going to be 20% instead of 10% previously for net gains within the basic rate band. For net gains outside the basic rate band, your rate of tax is going to be 24% instead of previous 20%. So these are the changes that were indicated in the autumn budget. In addition to this, the rate of tax that is applied to business asset disposal relief and investors relief is also changing. From the 6th of April 2025, if you sell any asset that qualifies under business asset disposal relief, the rate of tax will be 14% instead of the current 10% for net gains that falls within the first £1 million. From the 6th of April 2026, if you sell any asset that qualifies under business asset disposal relief, the rate of tax again is going to be 18% instead of the current 10% for gains that falls within the first £1 million. So these are some of the changes that were highlighted in the autumn statement. What can you do to reduce the amount of tax that you pay to help you retain most of your hard-earned money in your pocket? The first thing you need to check is if you have any capital losses that have not been declared to HMRC within the 4 previous tax years, you need to declare it to HMRC as soon as possible. This is because if you don't declare it to HMRC, HMRC will not know about this capital loss. And so you will not be able to use the capital loss against your future capital gains. And so it's important to declare this to HMRC to get it in your records. If you declare it, the loss can be carried forward against future capital gains. And this will reduce the amount of capital gains tax that you need to pay. This is one of the ways that you can use to reduce your future capital gains. Another way is if you have any capital asset that is held within your name only, you may consider adding your spouse, especially if your spouse is a basic rate taxpayer. This is because if you add the name of your spouse to this asset, in the future when you sell it, any gain that is realized from the sale can be shared between you and your spouse, reducing the capital gains tax that you pay, and in the household, reducing your entire capital gains tax. Again, if you share it with your spouse, you are each able to benefit from annual exemption amount for capital gains tax, which is currently £3,000. You will each have £3,000 to utilize against your capital gains to reduce the household tax. The last thing that I will provide with regards to ways that you can reduce your capital gains tax to help you keep most of your hard-earned money is utilizing all your annual allowance each tax year. So if you have any assets that you need to sell, don't wait till future. Each year, you can utilize your annual exemption amount against a proportion of your gain that you may get each tax year. Utilize all your annual exemption amount, which is currently £3,000. So these are the various tax efficient ways you can use to reduce your tax to help you keep most of your hard-earned money in your pocket. If you have found any part of this video useful, please send us a signal by hitting on the like button. Again, please hit on the subscribe button if you have found any part of this video very useful. The next thing we are going to talk about is about Employers NI. In the autumn statement, from the 6th of April 2025, Employers NI is going to increase from 13.8% to 15%. In addition to this, the secondary threshold for which employers start to pay national insurance is decreasing from £9,100 to £5,000. And finally, the employer's allowance, which is currently £5,000, is increasing to £10,500. Some of these changes will affect the amount of tax that you pay as an employer. And so what can you do to ensure that you reduce the amount of tax that you pay, both an employer and an employee, to keep most of your hard-earned money? The first thing you could consider is with the use of salary sacrifice schemes. Salary sacrifice schemes reduces the gross amount of income before tax. And so the amount of tax that you will have to pay will be reduced because of salary sacrifice. And so the tax will be reduced and the NI will also be reduced, which will help you as an employee if you join any of the salary sacrifice schemes, and you as an employer if you set up some of these salary sacrifice schemes, because it will help you reduce your national insurance that you pay and the tax that you pay as an employee. Implement salary sacrifice schemes. I have a video that I will link up above and also add a link in the description that provides various salary sacrifice schemes you can implement and the tax that you can save using the salary sacrifice schemes is very important with these tax rises. The next thing that you can use to reduce the tax that you pay as a limited company owner is with the combination of dividend and salary. Extracting funds from your limited company in a most tax efficient way helps you to reduce the tax that you pay and also helps the limited company reduce the corporation tax that it pays. A combination of taking a salary and dividend will help you achieve reduced amount of tax. Again, I have a detailed video that will provide you with various ways you can use to extract funds from your limited company. I will link up above, and again, I'll provide the link in the description area. Go watch it to see many of the tax efficient ways you can use to extract funds. So these are some of the ways you can use to reduce the level of tax that you pay, helping you to retain most of your hard-earned money in your pocket. Another thing that was highlighted in the autumn budget is with regards to stamp duty. And with this, please don't skip any part of this video because it's packed full of tax efficient ways you can use to reduce your taxes. And so don't skip any part. Stay with me. Stamp duty. The stamp duty rate is changing for the purchase of additional residential property from the 31st of October 2024. The rate of tax will be 5% instead of 3%. So for the purchase of any additional residential property, you will no more pay 3%. additional rate, but rather 5% additional rate. In addition to this, the purchase of dwellings by corporates, the stamp duty rate is also changing from 15% to 17%. So these are some of the changes that I would like to indicate in this video surrounding stamp duties. The next one that we are going to talk about is inheritance tax. Again, don't skip any part of this video because you don't want to pay inheritance tax at 40%. In the autumn budget, it was stated that the freeze on the new rate band, which is currently £325,000, is being extended from 2028 to 2030. In addition to this, currently your pension fund sits outside your estate, but from April 2027, your pension fund will sit inside your estate. So currently, if your estate value is up to the new rate band, which is currently £325,000, you will not pay any inheritance tax at 40%. With the introduction of pension fund being added to your estate, most of estates may attract inheritance tax at 40%. And so what do you need to do to ensure that you don't pay tax on your estate at 40%, but rather reduce the amount of tax that you pay on your estate whilst you're gone? So the first thing you need to do is to utilize the tax-free 25% lump sum withdrawal whilst you are alive. Withdraw this amount, it's tax-free anyway, use it. This will reduce your pension fund, and this will reduce your estate value, and this will reduce the inheritance tax that you will pay. The second thing you need to do is try to gift some of your assets if it's possible. Gift some of your assets to your loved ones whilst you are alive, to charities if you like giving towards good causes, to reduce your estate value. The assets that you gift to your loved ones to charities reduces your estate value and will not be included as part of your estate as long as you live for more than 7 years. These assets will leave your estate, reducing your inheritance tax, reducing the tax that you pay, helping you to keep more of your hard-earned money in your pocket, helping your loved ones to use more of your hard-earned money. So these are some of the tax-efficient ways you can use to reduce the tax that you pay. If any part has been useful, please hit on the subscribe button. Again, ask questions in the comment section. Share your experiences. Thank you for watching.